This is the Cash Value Solutions Podcast, where your hosts, Jason Pohlmeyer and Kyle Manns, shed light on little-known money truths to help you take control of your financial future and become your own banker. Subscribe, rate, and review the show, and check us out at cashvaluesolutions.com.
Hey everyone, welcome back to the Cash Value Solutions Podcast. We have a technical one for you here today. What are we going to talk about, Kyle?
We're going to be going over the anatomy of an IBC policy.
Okay. I think to do that for you guys, to have this make sense to you, we need to explain what a modified endowment contract is first.
Also known as a MEC.
Yes. And so how I want to do that is what a MEC is a life insurance policy that doesn't enjoy the tax favored nature that life insurance has. Okay. So with cash value life insurance, the cash value grows tax deferred. But when you do things correctly, you don't create a MEC, meaning you don't create a MEC.
Mm-hmm.
You can access that money tax free with withdrawals up to cost basis or policy loans.
Yep.
Okay. That is tax free because we have not created a modified endowment contract.
Mm-hmm.
Now, if we have created a modified endowment contract, the cash value still grows tax deferred. But this functions very similarly to a qualified plan if we withdraw money from it. There is typically a 10% penalty for money that is taken out, whether it's withdrawn or through loans.
Before age 59 and a half.
Before age 59 and a half. And we have to pay taxes on the gains in the policy. Typically, this is not something that younger people are going to want, a MEC I'm talking about. But we have written MECs for older people, some people in their 70s, because it fits their situation very well.
Yeah, and the death benefit is still income tax free.
Yes. Okay. So now to go a little bit further into the MEC conversation. There is what's called a 7-pay test. And every life insurance policy is subject to this. If you don't pass it, you become a modified endowment contract. So what that says is, in the first 7 years, you cannot cumulatively pay more premium into the policy than what it would take to guaranteed pay up the contract. Okay, here's a numbers example because I think that's really hard to understand. Say we have just created a life insurance policy with a $10,000 MEC limit on it, okay? The 7-pay test would say you can pay $10,000 into this up to $10,000 into this policy in any year during those 7 years. Now, you could do that as equal payments of $10,000 over all 7 years. You could do that as a payment like this. In year 1, you pay $8,000, and in year 2, you pay $12,000, and the rest of the years you pay $10,000. Okay? That's fine, because cumulatively, $10,000 in the first 2 years is $20,000. We only paid $8,000 in the first year, so we have the ability to go up to $12,000 in the second year because that still only equals $20,000.
Yep.
Okay? What you can't do if you don't want to create a MEC is pay $12,000 in the first year and then $8,000 in the second year because you crossed the $10,000 mark in that first year.
Yep.
Hopefully that makes sense to you guys.
It's about the easiest way of explaining it.
I'm sorry that is very technical, but you need that understanding for all this to make sense. So
getting to the anatomy of the IBC policy, it's how we design them. It's made up of 3 parts usually: base premium, paid up addition rider, and then a little bit of term.
Yes. Paid up additions, they're called different things by different companies. So you just have to be cognizant with whoever you work with to ask them what the paid up addition rider is.
Yeah, each company has...
There are no two that are the same.
No, they have different names for them, and they have different ways that you can pay into them.
Yes, flexibility funding limits. Everything is different with each company.
But maybe we should really dive into the base premium first, because that's really the foundation of the policy.
Right. Okay. You want me to take that one, Kyle?
Sure.
Okay. So base premium on the policy is money that needs to be paid every year in a life insurance contract. Okay. Now, to give you a rough example here, this all depends with age and health and things like that. But these are just examples to help you guys understand. If you pay $1,000 into a base premium, that may create $50,000 of death benefit. Now you have to keep paying that $1,000 every year because that $50,000 of death benefit is not paid up.
Mm-hmm.
You need to continue paying for it because the life insurance company has given you the life insurance, but it still requires payments to them to keep it in force.
Yep.
Is that a good explanation, Kyle?
Yeah, I think so. And the range of what the splits have to be for, because there are companies that require a minimum base. Some of them it's 10% minimum base of the policy. Some it's 25%. Sometimes it's lower than 10 or anywhere, in between.
Right.
So
it's going to vary, and we can't just give a generic, like, this is the right way to do it until we talk to somebody, because it just varies so much between person to person.
yeah, structure cannot be the same for everybody, we don't believe,
No.
to be optimal for them.
Right. Okay. So base policy due every year. You need to keep paying on it because that death benefit isn't paid up. One more thing to note. Dividends are paid, like, say, okay, companies charge you for the worst case scenario to provide the guarantees in the contract. If their experience is better than that, it has been for over 100 years, over 150 years with some companies, they pay dividends. So of that $1,000, how that would be classified, the dividend is a return of some of that premium to you.
Yep.
Okay? Dividends are more favorable on base premium dollars than they are on paid up addition premium dollars.
Yes.
Okay. Do you want to take the PUA, Kyle?
Yep. So we refer to it usually as the PUA rider, which is the paid up additions rider. The paid up additions rider is what adds flexibility to these policies. So what it actually is it's paid up insurance. So you are buying many insurance contracts essentially that are completely paid up. And so really they're mini mechs. And we blend that with the base premium to be able to avoid mech status.
Exactly. It's also important to understand, like Kyle said, it's paid up. So in a numbers example, like say $1,000 paid into the PUA rider, that may create, say, $3,000 of death benefit. Okay? That $3,000 of death benefit is paid up. It has no more premium required from you. It's just paid up. That is why the PUA riders with some companies are flexible and they don't require payments every single year.
Yep.
Because you've already paid for the death benefit that is associated with that mini policy.
Yep.
Okay. Still important to remember, people will like to call this, this is like putting cash into your policy or things like that. All these things are premium to the life insurance company, and you should probably not enter into a life insurance policy if you aren't comfortable with the fact that this is all premium to the life insurance company. You need to understand that.
Mm-hmm.
The reason it's not okay to call that cash is because there's death benefit associated with it. You guys, to really understand and become your own banker, we help you with this, but these are things that if you understand, you have less questions and are able to move faster.
Yeah.
Okay. You want me to take the term insurance rider, Kyle?
Sure.
Okay. This is something that we can put on policies. We don't have to. And this is also to explain this rider is why we explained what a mech was at the beginning of the podcast. Typically, to create enough room inside of a policy to put money into the PUA rider, or as much as we want to in it, we need to create more death benefit, because your age and the death benefit of the life insurance policy have a direct relationship to what the modified endowment contract limit is, or the 7-pay test, okay? The $10,000 example I gave earlier. So we attach these term riders to create more death benefit to bump up the modified endowment contract limit, or the 7-pay test limit, so we can put more money into the PUA rider.
Yeah, so we get your cash values up.
Yeah, we
sooner.
boost your short-term cash values, and it also boosts long-term cash values.
Putting more money at work, earning interest and dividends at uninterrupted compound interest.
Exactly. Term insurance is a very cost-effective way to raise the death benefit, so we can do this. That is why we will attach term riders to life insurance policies. Also, I forgot to mention this when Kyle was explaining it. He mentioned many policies, the single or the paid up additions rider, the money that we put into those as mini policies. Okay, that is completely true and accurate. What you should know, though, is the company does not say, after you've paid into the paid up additions rider, say 10 times, that you have one policy with your base premium plus all these paid up additions that created mini policies. Mm-hmm. They lump it all in as one big policy, okay? It's simple for you to see. It's all shown as one policy.
Yeah, and we talked about the base premium has to be paid every year, and it does as long as you want to keep paying into the policy, but we can reduce pay up that after paying into a certain amount of time, whether it's 4, 5, 6, 7, 8 years, somewhere in there, depending on company and person.
Right.
But you don't have to. We can reduce these up if needed.
So let's explain that. What does reduced paid up mean? That means that no more premium is due to carry out the policy has no more premiums due on it. Okay, even if you want to, you can't pay premium into this policy. How they reduce pay up a policy is, say you have a contract and you have, say, $40,000 of cash value in it, for example. They will look at how much death benefit that $40,000 of cash value will create and reduce pay up the policy to that. It's guaranteed to be no more premiums due. You can still earn dividends. You can still withdraw and do policy loans with the policy. You absolutely cannot add more premium to the policy once you do that, though.
Yep.
So one way around that potentially is, if you don't think you want to pay into the policy, would be to do what's called a premium offset. That means the policy itself, the dividends and interest, the dividends and any paid up insurance would be used to pay the base premium on the policy.
Yep.
And the term insurance, probably.
And then you could decide later on if you wanted to pay more money into it.
Yes. When you elect that premium offset, that's something that you don't have to elect for the entire life of the policy. You can change that in a year or 5 years or 10 years. You could even premium offset a policy and then decide, well, I'm sure that I don't want to put any more money into this, and then we reduce pay it up.
Yep.
Why do we do reduce paid up? It reduces drag, I guess you could say, on the policy. Cash value is going to grow a little faster than what it would with a premium offset. Drawback is you do have less death benefit in force when you reduce pay up a policy.
Yeah.
When you reduce pay up a policy, that is permanent. You cannot take that election away. And as I said earlier, no more premium can be paid into that policy. Can't be done.
So it's not a light decision.
No, that one is permanent. You don't have to elect it at the beginning of the policy. It's just a non-forfeiture option with whole life insurance that you're given the option to elect if you want to.
Mm-hmm.
So, okay, we covered base, term, PUA riders. We explained MECs. Hopefully they understood that. Anything else that we should be covering on this?
Nope, I hope you guys aren't completely glossed over. And so,
there is one thing now that I think about it. Flexibility with PUA riders. It's different with every company. Because it's paid up insurance, it has no more premium due, so that's why you don't have to pay into it. But some companies will reduce your ability to pay into that rider if you don't use all your, say you have the ability to put $5,000 into the PUA rider and you don't use all of it. Some companies will reduce the amount that you can pay into it because you didn't fill it all the way. Some companies will allow you to add money into that whenever you want to. That's what we typically like because we just don't know what cash flows you're going to have.
Yeah. Flexibility is huge.
Flexibility
takes stress off of this too.
Huge.
It makes you feel more comfortable if you want to pay big premiums. It makes you feel comfortable that, hey, I don't have to pay this big premium every year.
Absolutely. If you're on the hook for a $50,000 premium, it's nice to know that maybe only 10,000 of that or so, or 15,000 or maybe less than that is due every year, the base and the term. And you have the ability to put money into PUAs at your discretion when you want to.
Yeah.
So, PUAs are huge though. They are what create the cash value inside of the policy. Initially, base premium does come back to work for you, and create cash value. It just isn't immediate like it is with the paid up additions rider because you're paying for death benefit.
Yep.
There's continued premium due for that on the base premium.
Sure.
Okay. That's everything I have to add, Kyle.
One last thing I'd like to add is all this technical stuff. This is a very technical podcast, and there's a lot that goes into making these IBC policies. So it's important that you guys use somebody who is infinite banking certified through the Nelson Nash Institute, not just any Joe Blow who sells life insurance and says, "Oh yeah, I've heard of the concept or I've read the book," because more than likely they don't know all this information because they haven't been through the process of the certification.
Absolutely. And not only that, but just being around like designing these type of policies. Like most insurance agents just sell policies that are base premium.
Mm-hmm.
Okay. That is just what the industry has taught them.
Yeah.
This companies don't teach this, designing policies for cash value accumulation typically. Not to say that they never do, but it's just not common.
Mm-hmm.
So that's huge advice, Kyle. I mean, it is so important. You want to get this right the first time. You don't want to go and in 3 years regret doing this.
Yeah.
Because the policy wasn't set up right and it's not what you thought you were getting.
And we see cases where people talk about, oh yeah, they gave me this infinite banking book and I read it and then they set me up this policy and it is not an infinite banking policy.
No, and then you're upset and it just leads to a lot of
resentment.
Yeah. So very important, good advice, Kyle.
Yeah. So thanks for tuning in this week and we will talk with you next week.
All right. Thanks, guys.
This was the Cash Value Solutions Podcast. Remember to subscribe, rate, and review the show. Check us out at cashvaluesolutions.com. And don't forget to tune in next week.